Hi, I'm Kevin Walton with C2 Financial, and I do real estate loans in California. And today I'm going to highlight a loan where you can qualify for this loan using Social Security income only. A lot of people don't know you can qualify with Social Security only. However, with this specific type of loan, you can. So I'm glad you're here. Let's jump right into it. Okay, let's go over the loan scenario. This is an actual scenario where I helped this gentleman. He's 68 years of age. He's recently widowed. His current home value is $623,000. His first mortgage balance $80,000. Mortgage payment $800. His current income is $1,100 only in Social Security. Liquid assets of $1,500. And he wants a loan of $239,000. That's what we settle on, and I'll go into that in a moment. His goals are to extinguish the first mortgage payment, establish an equity line of credit he can pull from for emergencies or whenever he needs it, and maybe he'd like to do a bathroom remodel, possibly with a walk-in tub. So let's see if we can help this gentleman. Okay, so here's a breakdown. A $623,000 value, mortgage, existing mortgage and loan costs of about $97,000 gets rolled into the loan, and then he wants the equity line of $142,200, and equity left over is $383,800. That was important to him. He wanted to make sure he had some equity left over after doing this. So let's go a little bit more into how we get this done. The unique thing about this loan is that how it gets income qualified. There's a feature on this loan that is not on any other loan. And please hit that like button so other people can find this loan, because they're looking for this option. I run into people all the time who don't know they can do this. So there is no debt to income ratio on this loan. Now, what is debt to income ratio? When you get a conventional loan or a home equity line of credit loan, let's say your income is $6,000. They say, okay, no more than 39% can go out to debt, which is about $2,300. And after they deduct the first mortgage payment that you're looking for, plus taxes, insurance, and consumer debt, if you have money left over after subtracting that $2,300, you income qualify. This loan doesn't have that. It has residual income, which means what's left after you've paid your debts. And we're going to go over a scenario a little bit more here in a slide or two. You also get to pick your monthly payment you want to pay back this new loan. Very unique. This is even more so unique. The available line of credit, if you can get one on this loan, if you have enough equity to obtain one, we can convert that available line of credit into monthly income to help income qualify for the loan. It's called imputed income. Let's take another closer look at that. Okay, so we take the credit line available, in this case $142,200. Then we go to the HUD tables, Housing Urban Development. This gentleman is 68 years old. The mortality table with HUD says 84 years of age he's going to live to. So we take that difference there. That's 192 months. And we divide it into the $142,000 credit line. And what we pull out of that is $740. Now, does that mean he has to take that $142,000, leave it in the credit line, and then pull from it? No. The bank just knows that with an abundance of equity in the home, they feel safe. But also, if push came to shove, if he needed additional income to live, $740 a month is going to last until he's 84 years old. It's just income qualifying funds to help him get the loan. It's not funds he's actually earning. So here's a snapshot of the actual software that we use to do these loans. So we have his income here, $1,100 in Social Security. Then we subtract from that his taxes, property taxes, and homeowners insurance premium in the form of a monthly payment. So we take the taxes annually, the insurance divided by 12, that's $450 here. That is a debt that we have to show that he is paying. $168 in utility charges. Now, how do we get that? I don't get his utility bills. We just look at his square footage of his home and multiply that times a factor. And what comes out of that is $168. Now, luckily in this case, this gentleman had no other consumer debt. He didn't have any car loans or any credit cards. Otherwise, we'd have to add that to the $618. The $618 is the taxes, insurance, and the utilities add together. Now, with this loan, the residual income that's required that he have left over at the end of the month after paying his bills is $589. That's for a high-cost area in Southern California. Other areas and counties could have different numbers, lower numbers. Now, that's for one person, that $589. He doesn't even have that. When you subtract the $618 from $1,100, it's $482. He's short $107 to meet that. If he had a spouse, he would need about $998 left over at the end of each month, not $589. And if he has 3 people living in the home, he needs $1,035. So it goes up a little bit when you have additional people living in the home. But just for one person, he's short. That's where the imputed income comes in. We pull that out of the credit line, add that to the Social Security, and we get $1,840. Then we subtract his payments here of $618, which is the the taxes, insurance, and utilities. Now, notice in that $618, there's no mortgage payment. No new mortgage payment we have to account for, because in this loan, you don't have to make a mortgage payment to pay it back if you don't want to. So we don't count it. That's another part of this loan that's beautiful to try to qualify for. It makes it much easier. So when you subtract the $618 from the $1,840, we get $1,222. So that's more than $589. So does the income qualify for this loan? Yes, because the imputed income gave him that extra boost to help him get there. So again, make sure and hit that like button. Other people have got to find this loan, find this option, find this video, and see if it works for them. So can this borrower income qualify for this type of loan? $1,100 in Social Security earned income only for a $239,000 loan? Yes. Yes, he can. What type of loan is this? A reverse mortgage. Some of you may have already figured that out, but please don't click out yet. You've got to know some things about the reverse that have changed for the better that you probably or may not know. This is not the loan that it was 10, 30 years ago. It was not a good deal. I mean, this loan had some issues. But with the revisions that have been done, and the guidelines and deletion of many of the types of loans, it's really simplified it and made it safer to use. I wasn't on board with it even 10, 12 years ago either, until they made these changes. So the underage spouse rules have changed. Those were not friendly before. There's now financial assessment, which means they have to have a little bit of income to get this loan, as I just showed you. It used to be if you had a pulse, you had a lot of equity in your home, they just gave it to you. Not so much anymore. They want to make sure you have some funds coming in. There's counseling on this loan, which means there's a third party that comes into play, has a telephone appointment with the borrower to make sure they understand the loan process. If they don't, can't go forward with the loan. Also in California, there's a 7-day cool-off period, which means after counseling gets done, they get 7 days where the lender can't submit a loan application. It gives people time to ask questions and make sure this is something they really want to do. I think the cool-off period is something good, and it's really important so that people don't get rushed into these loans. The leftover equity after the property sells or the loan gets paid off goes to the heirs or the homeowner, not the bank. It used to not be that way 30 years ago. It's just not that way anymore. A lot of people don't know that. Again, please hit that like button. Other people need to find this loan option. 55 years of age is all you have to be to get one of these loans. The one you see on TV is age 62. So there's 2 different types of reverse mortgage loans now. They both have different sets of rules and do different things. There's even a second mortgage, reverse mortgage. So you can go on my YouTube channel. I have videos on all those that explain all those. So just for the sake of time, just know there are different types of loans out there, but not all of them are available in all states. So you do need to have an abundance of equity to get these loans. It must be on your owner-occupied residence. Can't be on a rental property. Credit doesn't have to be perfect. Has to be free of health and safety issues, where you can't be in the middle of a remodel. Can't get one of these loans if there's construction going on. Can't get really any type of real estate loan. Construction's going on. You want to get the loan first, then do your construction. And again, the home does not have to be paid off to get a reverse. Single-family residence, condo, manufactured homes made after June of 1976 are all eligible. And again, as I mentioned, not all reverse mortgage options are available in every state. A couple of additional features you might not know about. The HECM reverse mortgage, the one over age 62, that line of credit is the one we're putting in the example here, stays open for the rest of your life. The bank cannot close it. If the value of the home drops, the loan stays open. It's not like a HELOC. It's much safer than a HELOC as far as that's concerned. It doesn't freeze after 10 years like some HELOCs do. It's a non-recourse loan. If you ever end up owing more than the property value, you don't pay the gap. You don't pay the difference. Neither do your heirs. The insurance companies either have insurance or they just absorb the difference. HELOCs are not that way. If you don't have enough to pay them off, that lien will follow you. The available line of credit you have grows every month. Really cool feature. It takes your line of credit available that you haven't used, multiplies it times the rate on the loan divided by 12 months, and that amount gets tacked on the balance of what you have to use every month. So that thing can grow up, up, up. I have a video on that explains that as well. Very unique feature on the HECM line of credit that no other real estate loan has. The amount you have available to use grows every month. No mortgage payments for the rest of your life. You can make payments though. A lot of my clients do. Any amount, as often as you want. Trust me, the bank will take your money. And borrowers again or heirs get leftover funds after the loan is paid off. So there you have it. Thank you for your time. Hit that like button. Other people have to find this. You can qualify for a loan on Social Security only. I do loans in California only. There's my contact information there. Feel free to drop me a line with your scenario and I'll answer. Even if you're not in my state, if you have a question, I'll help you. So thank you again for your time and we'll catch you in the next one. Bye.